Okay, so hello, assalamu alaikum students. This is your teacher Sabat, and the concept which we are going to discuss about accruals and prepayments. Basically, this is a part of your O level syllabus, O levels, IGCSE, and A levels also, because this is kind of adjustment in your final account. So that is why it involves in O levels, IGCSE, and A levels also. Okay, so before going to discuss about the accrual and prepayments, I think we should discuss that why it is essential and which type of final accounts it will these accrual and prepayments involve. Okay, so we all know that accounts are divided into basically two categories. So first one is income statement, and the second one is statement of financial position. Statement of financial position. So in short, you can say that SOFP. Okay, so you can say in short SOFP. So we all know that in income statement, it totally indicates a profitability position of the business, like how much profit our business have earned in a 1 year. So we all know that how to deal with this, how to make income statement. We know the basic format of income statement. So it indicates basically profitability position of the business and indicates the earning capacity of the business. And it helps us in finding how much revenue is generated and through what sources and how much expenses are incurred and by what means. And it was previously known as trading and profit and loss account. Income statement is a new name, not income statement, basically profit and loss statement. Profit and loss account. Okay. So this is the new name of income statement. So basically this indicates us the profitability of the business, the revenue, and how much expense has incurred in a whole year. Okay. And these kind of expense, like different operating expenses. It could be your water expense, and it could be salaries and wages and like these kind of things, which is expenses, which could be interest, the the interest on bank loans. So these kind of expenses come under income statement, means profit and loss account. And in statement of financial position, it shows a detail of assets. We know that assets further divided into two parts. The number one is fixed, and you can say fixed and also non-current asset. And the second one is current asset. Current assets basically those assets which have more one year, more than 1 year life. And non-current assets, current assets are those assets which have less than 1 year life. Okay, so these kind of assets are called current assets, which have shorter life, shorter than 1 year. So basically, statement of financial position, it shows the details of assets, like how much of net book value, how much of the worth of the assets we have, and like if we have machinery, so what's the worth of that machinery, what's the net book value of that machinery. And if it is about the bank balance, like if we go into the current assets, so there are a lot of current assets. So in these current assets, we have trade receivables and bank at balance at bank, and our closing inventory and our other advance like prepayments, advance, you can say that expenses. So our main motive is that how accrual and prepayments concept affect the profit and loss account and statement of financial position. So I have told you that statement of financial position shows our details of assets, liabilities, and capital on a certain date. And it shows it was known as balance sheet. The previous name of statement of financial position was balance sheet. So basically, final accounts, these two are basically final accounts. These are final accounts, which we have to make at the end of the year. So final accounts are prepared when the accounting year ends, but it published after 3 months. So any changes occurring during these 3 months, which impacts the figures of the previous year, are called the adjustments. And hence they must be taken into consideration before the final accounts are published, so that the financial statements reflect a true and fair value view of business performance and are reliable. So some adjustments that need to be incorporated are as follows. So there are basically two type of adjustments, not basically two type, there are a lot of other type of adjustments also, but in this video we are specifically going to discuss about the mainly two types of adjustments. The number one is prepayments and the second one is accruals. Okay, so first of all, let's discuss about the prepayments. Okay, so basically what's the meaning of prepayments? They are also known as prepaid expenses. Okay, prepaid expenses, the expenses which maybe you have paid, but you didn't occur that expense. For example, um, if you have to market your product, market, or you can say that advertise your product through a marketing agency company. Okay, like you hire a company for marketing or advertise your product, because businesses always use these type of companies, because these companies basically you can say they're specialized to advertise different products. They know that how to use different tactics and different strategies to advertise your product, so you can reach to your audience easily and you can reach a maximum amount of people, and so people can know about your product and they can purchase from you. So that is why you are businesses always approach marketing agencies for advertising. So that is why, like if you have to market advertise your product, so through a marketing agency, so if you are paying something to the marketing agency, because of course you have to pay, so it means that that payment basically is expense. Okay, so if you pay $5,000, So, for example, your year start at January 2012. Your financial year start at January 2012, and your financial year ends on January 2013. Okay, and you have paid $15,000 to the marketing agency. Okay, so for example, if it is 1,000 for per month, like you have to give 1,000, you have to pay 1,000 for every month of marketing. So it means that if it is about the 12 months, so we have to pay 12,000 for whole month, like for January 2012 to January 2013. Basically, 31st December, not January, 31st December. And year start at 1st January. Okay. So it means that if you're supposed to give 1,000 per month for marketing, and if you paid $15,000, maybe on 1st January 2012 to 31st December 2013. So it means that you paid $3,000 extra. This is your extra amount. So you can say that it is your prepaid expense. So if you are going to make your financial statements for January 2012 to January to 31st December 2013, 2012, sorry, 31st December 2012. So what it means basically, so it means that 3,000 would be extra for January, February, and March 2013 onwards. So 3,000, you just have made this payment for January, February, and March. So you just paid 3 months extra payment. So this is your prepaid expense in your income statement. And we should not consider this 3,000 extra in our income statement, because this is not related to this year's expense. If you are making an income statement and profit and loss account for 2012, so all the expenses which linked with only 2012, only that type of expense should be considered and should be written in the income statement. So this $3,000, which is for 2013, it is not for 2012 expenses. So it means that we should not add this 3,000 in 2012's income statement. Okay, but because it is an extra payment, it is an advance payment, it is a prepaid expense. So that is why we always minus 3,000 from 15,000, and we would only write $12,000 in 2012 income statement, because this is related to that specific year's expense. Okay, so this is how it is. So what will we do what we will do with this $3,000 basically? So basically this $3,000 is our current asset, because we can claim on it. We can claim on it because this is our current asset, because we didn't use it right now. We didn't use till 2012. We will use this 2013 for January, Feb, March. So this is our current asset, because we can use this, and we have we have this amount to the marketing agency. Here, so that is why current assets of this 3,000 basically current assets for the business. Okay, so after that we are going to discuss about the accruals. So what are accruals? They are basically expenses incurred but not yet paid. Okay, like if we just keep this example as it is, so it could be like this. We have to pay 12,000 for $10,000 for 1 year through the marketing agency, but we have paid only $10,000 for 10 months. So we are making 2012 balance sheet to 2012 statement of financial position. So what we have to do? We just paid 10,000, but you're supposed to pay 2,000 more. Why? Because it is related to 2012 marketing expense. Because you use the services of marketing agency. You use the service of marketing agency, like you use the service from 1st Jan 2012 to 31st December 2012. You used you use marketing agencies all services, complete services for 1 year. Okay, but you didn't pay this $2,000. You just paid only $10,000, but you should pay 2,000 more. So it means that this $2,000 associated with 2012 year. Okay, so you're supposed to pay this 2012 to $2,000 in 2012 expenses. So that is why if you find any adjustment that maybe your expenses basically accrued, so you have to add this accrued expense into your total expenses which you will find in the trial balance. Okay, so what we have to do is, for example, in our trial balance, there has been written in your trial balance that you have paid $10,000 to the as marketing expenses, and in adjustment section in the notes, you will find that $2,000 basically accrued expense to the marketing agency. So when you are going to make the profit and loss statement, so what we will have to do, we will have to add 10,000 plus $2,000, because this is the amount which we have to pay during the year, but we didn't pay. So but we add $2,000 into 10,000 because this is related to this year's expense. We cannot shift $2,000 to 2013. Maybe we will pay this $2,000 in 2013, but we have to mention this $2,000 amount into 2012 year's profit and loss statement. Okay, because it is you can say that necessary, and it is you can say that a rule that we have to pay, or we have to add all expenses which is related to that specific year. Okay, so it means that $12,000 would be add into 2012 profit and loss statement. Okay, so this is how it is. Like we have to make this like accruals basically, they are the expenses incurred but not yet paid. Okay, like we have like we can say that we have used the services from marketing agency, but we didn't pay it yet. Okay, but this has to be related to that specific year, in 2012 because we use their services in 2012. So we should add extra amount, like which amount we didn't paid yet, which is $2,000. So we should add this amount in 2012's profit and loss statement. Okay. So these are the expenses paid but not yet incurred. They are the expenses due but unpaid and or also known as accrued expenses. Or you can say that outstanding expenses and owings. So it could be utility bills, it could be your water supplies, like all type of expenses which you didn't paid yet but you have used the services. Okay, so what will the effect on the statement of financial position of this accruals basically? So this would be current liability for the business. So we would add this $2,000 in statement of financial position under current liability. Why we are considering this $2,000 under current liability? Because this is a liability which we have to pay within a 1 year. It is not kind of any loan, any bank loan. We don't have to pay this after 5 years or maybe within 5 years. We have to pay this $2,000 in within 1 year. So that is why we would write this $2,000 under current liability. Okay, so I am going to just give you a small formula. If it is prepaid expense, if it is prepaid expense, so it will minus from the profit and loss statement. Okay, and if it is accrued expense, so it will add um it will add in profit and loss statement. Okay, so you can use this short you can say that formula into your mind, so you can easily know that okay, when we are going to make our income statement, so what we have to do. So if it is accrued expense, if it is accrued expense which the expense incurred but not yet paid, so it would be our current liability in statement of financial position. Okay, and if it is prepaid expense, like we didn't incurred any expense but we have paid advance payment for to any company which we are going to have services for from, so prepaid expense would be current asset in statement of financial position. Okay, so this is the main concept of accrual and prepayment. Okay, so sometimes there are also not only expenses, accrued expense and accrued income, accrued expenses and prepaid expenses. There are also some accrual and some prepaid income. Okay, so let's discuss about the accrual, or you can say that accrued income. So let's discuss about the accrued income. So what is accrued income basically? So they are basically the incomes earned but not yet received. Okay, it means that you have given a service to your customer, okay, but your customer didn't pay it yet in the financial year, the specific financial year. Okay, so they are the incomes earned but yet not received. You didn't receive any payment, but you have served them, like you have gave your services. So for example, if you gave your services to your customers, but your creditors, like your customers didn't pay you, so these type of income is called accrued income. So they are also known as arrears and are current assets for the business, because you have like you have a claim on it. You can, because you have given the services to your customer, so it means that you have a claim on your amount which we are going to receive in future from our customer, because we have given our specific services to our customers. So that is why these accrued income would be the current asset under the statement of financial position. So what it could be, like it could be commission or of a commission agent. Okay. And the second one is pre-received income. What is pre-received income? So basically pre-received income, or you can say that unearned income. So they are the incomes received in advance but yet not earned. It is totally opposite to accrued income. In accrued income, you have given the services to the customers, but your customer didn't pay you in the specific financial year. Okay, and in pre-received income means that your customers gave you some extra amount. Okay, you didn't serve them, like you didn't give any services to them yet. So this is basically pre-received income. So they are the incomes in received in advance but yet not earned, and hence the current liability, because this amount which you have, basically it is an extra or advance payment from your customer, and your customer can claim on it in the future. They can say, okay, we don't want your services now, so you should pay back our amount which we have paid you extra, when which we have paid you an advance amount in the previous months. Okay, so this is how it is. So it is totally opposite to the prepaid expenses and accrued expenses. In accrued income and pre-received income, you are basically the supplier and the other one is your customer. But if it is about the accrued expenses and prepaid expenses, so basically you are the customer and the second person is supplier. Okay, so this is like it has basically you can see that these accrued income, pre-received income, or accrued expense and pre-paid expense basically describes the two relationships between the supplier and the customers. Okay. Okay, so now let's discuss about it. We just discuss about that if we have some adjustments which we have to you can say that adjust in our statement of financial position and income statement. So what we have to do, like we just discussed this specific area of accrual and prepayments, but CIs, you will find a full-fledged question of accrued and accrual and prepayments. Okay, so we have to know that which type of format we should follow if we will have any kind of um, prepaid prepayment and accrual question. Okay, if it is about the expenses, it could be prepaid expense, or it could be accrued expense. Okay, like if it is about expenses, so it could be accrued and it could be prepaid. Okay, because in 1 year maybe maybe we just you can say that prepaid some expenses, or maybe we have some accrued expenses also. Okay, so like if we have expenses, so it could be prepaid and it could be accrued. So what type of format we have to follow? We just need to remember one mnemonic, and which is POP. Okay, so what is the meaning of this POP? You can say that POP account. Okay, so what we have to do is, in POP account, okay, so basically in POP account, prepayments, if it is about the opening balance, it would come at the side of the debit side, which is debit, and this is credit. Okay, and if it is accrual opening balance, so it would come under the credit side. Like it is the start of the year. Okay, like if it is about the 2012 uh 1st January. Okay, and it is also 2012 1st January. Okay, so if it is the start of the year and you have some prepaid expense, so it would come under debit side. And if it is accrued expense at the start of the year, you will find accrued expense at the start of the year, so it will come under the credit side. Okay, so after that, cash, bank, income statement. This transaction will happen during the year. Like it will be start after the 2012 first January. Like it would be start in Feb, March, April, May, June. Okay, like till the financial year ends. Okay, so if we paid any expense during the year, so it will come under the debit side. Why? It is just because of this expenses, that always debit. Expenses, the nature of expense is debit. So basically this is debit, expense is debiting basically, and cash and bank would be credit. If you know the double entry system, so you can easily understand this concept. Like if we incurred any expense, okay, like um if we paid $200 to water supplies, so we know that water supplies basically is an expense. Okay, so it would debit by $2,000. Okay, and cash, if we are paying this by cash or if we are paying this by check, So cash and bank would be credit by $2,000. So PAP is basically the expense account. So that is why cash and bank would come under the debit side, but in real cash and bank is going to credit. Cash and bank would be credit, and in PAP account, expense would be debit. And we all know that at the end of the year, what will happen? Are all type of expenses, um, are all type of expenses would fall in income statement. Okay. And if it will fall in income statement, it will credit and your income statement would be debit. For example, if we are talking about this water supplies, okay, this water supplies. So this is the initial entry that, okay, if we pay $200 to the water supplier, so we know that, okay, our water suppliers would be debit and our cash and bank would be credit because we are paying some amount to the water supplier. So of course, our amount is going outside from the business. So that is why cash and bank would be on the credit side. And water supplies are expensive. So that is why it would be come under the debit side. But if we are going to, we can say that if we are going to make our income statement after 1 year, so what will happen? This water supplies amount, like $200, it would basically, we know that all expenses in the income statement would be debit. Okay. So in income statement, what is the double entry for income statement? Like if we are going to um, post this expense water suppliers into income statement, so what we will have to follow, what type of entry, what type of double entry we will have to follow basically. So income statement would be debit. So we all know that expenses would be debit income statement. So what will happen to water supply? Like we have to close the water supplies account. So that is why if we are going to close any account, because it is the time of the end of the year and we have to grab all the expenses and we have to post all the expenses into income statement. So that is why in income statement it would be debit, but in what happened to the water supplies and different expenses account, it would be credit. Because we are going to nil this account. So that is why water supplies would be credited by $2,000. Okay, sorry, $200. Okay. So that is why our expense account, this is our expense account, we know that. So that is why our expense account would be credit and income statement is going to debit. Okay. And accruals, okay, so now we are going to discuss about the revenue, or we can say the accrued and prepaid income account. So we will use this mnemonic, which is APA. So it means that A means accrued, P means prepaid, P means prepaid, A means accrued. So A, accrued income, basically, if it is about the balancing fee, opening balance, so it would come under debit side. P means prepaid income. It would if it is your opening balance, so it would come under credit side. And after that, in at the end of the year, you have pre-received like prepaid income.
Prepaid income. If it is balance CD, so it would come under the credit side, debit side. And accrued income. Accrued income balance CD would be come under credit side. Okay. So after that we will total that. Okay. So what is happening to the income statement and cash at bank? So basically this is our income account. Okay. So that is why we all know that all type of incomes would be credited in income statement. Okay. So what is happening when we are not making our profit and loss statement? For example, we received $100 as um, commission. $100 as commission. So what will be the entry of this amount, this transaction? Commission would be credit by $100 and cash would be debit because it is increasing. Cash is increasing, cash is a current asset. So that is why it would be debit by $100. Okay. But if it is about the at the end of the year, like we are going to make our income statement. So what we will have to do? We just nil this commission account. We have to just nil this commission account. Okay. Like we have to, you can say that nil or we have to finish the commission account of the specific year. Like we are going to make the profit and loss statement for 2012. So it means that we have to close the commission account for 2012, only for 2012. So what we have to do, we will debit the commission account. Okay. And we will credit the income statement because all type of incomes will be credited under income statement. So we have like we know the basic concept of debit and credit. So it will credit. Income statement will be credited by 100. So this is the same in happening in this account, in this APA account, APPA, accrued, prepaid, accrued. So in this basically income account is when we are when we are receiving any amount during the year, so our cash and bank would increase. So that is why income would be credit and cash and bank would be debit. But at the end of the year, when we are going to post all the income to the income statement, so what we have to do is we will debit the income account and income statement would be debit. Okay, that is why um, we have to write income statement under the debit side of the income account. So basically, income account is debiting and income statement is crediting. Okay, so this is the concept. So like you just have to remember the APA mnemonic, and if it is about the PAP account, expense account, it could be prepaid, it could be like it could be both prepaid and accrued. So we have to follow this mnemonic, PAP account. Prepayments, accrued, prepayment. If it is opening balance, prepaid expense opening balance, so we will write under the debit side. If it is accrued expense opening balance, so we would write under the credit side. And the closing balances would be accrued expenses, closing balances would be come under debit, and prepaid expenses, closing balance would be come under credit side.